If you are new to investing or just looking for more stocks content to consume like I do, please sit back and enjoy these 25 tips for investing in the stock market. Let's start. 1. Invest in what you know. Start with companies you understand from your daily life, like stores you shop at or products you use. It is extremely satisfying to invest in a business that you can see and touch versus a company that you have never heard of. Take, for example, Apple. You've probably used their products every day. Tesla. Either you own one or you see them on the road. Lovisa Holdings for fashion jewelry. Netflix for entertainment. JB Hi-Fi for all your tech purchases. Nick Scali for boutique furniture. These are just a few of the many businesses out there you can see and touch every day. 2. Do your homework. Research a company's financials, products, and growth potential before investing. An easy place to get this info is from the company annual report. The annual reports even provide an outlook into the years ahead to help you see how the company will grow. 3. Stocks are ownership. Buying a stock means owning a piece of a business, not just a ticker symbol. Being a part business owner in lots of great companies is a fantastic feeling. Trust me, it's a great way to impress friends and family by saying you are a partner in multiple businesses. 4. Focus on the long term. Great companies grow over years, so prioritize long-term gains over short-term fluctuations. 5. Patience pays off. Hold on to good companies through market dips to benefit from compounding returns. Do not be scared off by short-term bad news. 6. Avoid market timing. Trying to predict market highs and lows is a losing game. Have your researched stock watch list ready to buy during market dips. If a stock looks expensive, but you don't want to miss it, start with a 20 to 30% buy. Then buy more later on, hopefully at a cheaper price. 7. Look for 10-baggers. Seek companies with the potential to grow tenfold, often small or overlooked businesses. The earnings and revenue growth research can help identify the growth stocks. 8. Understand financial statements. Learn to read balance sheets, income statements, and cash flow reports to assess a company's health. Looking at annual earnings, revenue, debt, profits, return on equity to give you an idea about the financial health of a stock. 9. Earnings drive stock prices. A company's earnings and profit growth are the biggest factors in its stock's long-term value. 10. Start early. The earlier you invest, the more time your money has to grow through compounding. 11. Invest regularly. Even small, consistent investments can build significant wealth over time. This is what they call dollar-cost average investing. 12. Don't chase hot stocks. Avoid buying stocks just because they're rising. Base decisions on research. Stocks can quickly crash when investors notice that earnings have not been growing with the price. 13. Diversify, but not too much. Own a variety of stocks, but don't spread yourself so thin that you can't track them. You need to be able to keep an eye on the stock reports and announcements. Too many stocks, and it gets a bit overwhelming. At least 10 is good for diversity, but probably no more than 30. 14. Ignore market noise. Short-term market swings and media hype do not reflect a company's true value. 15. Buy growth at a reasonable price. Look for companies with strong growth potential, but avoid overpaying for stocks. You can use the price-earnings-to-growth ratio, known as the PEG, to help identify expensive stocks. Sometimes growth stocks always look expensive, so it can be a good idea to invest a portion, like 20%, just to get in, and perhaps buy more later during a dip or correction. 16. Know why you own a stock. Have a clear reason for every investment, based on the company's story and financials. Doing this helps you sleep at night. 17. Reinvest dividends. Dividends can boost returns if reinvested, especially in growing companies. 18. Don't panic in downturns. Market crashes are normal. Stay invested if the company's fundamentals remain strong. Market crashes are actually good buying opportunities to buy those expensive growth stocks. 19. Learn from history. Study the stock market as past to understand that it rewards long-term investors. Profitable, growing businesses always go up when you zoom out. 20. Small companies, big potential. Smaller companies often have more room to grow than large, established ones. 21. Debt matters. Avoid companies with excessive debt as it can cripple their ability to grow. Keep an eye of the Altman Z-score of your stock. Ignoring stocks under a Z-score of 3 will help you sleep like a baby. 22. Cash flow is key. Companies with strong cash flow are better equipped to reinvest and weather challenges. 23. Be curious. Use your everyday observations to spot trends or companies before Wall Street does. Institutions generally are prohibited from buying small companies until they reach a large enough market cap size. This means you can be an early investor, which can be very profitable down the road. 24. Stay disciplined. Stick to your investment strategy even when emotions or market volatility tempt you to stray. It can be extremely hard not to react and sell stocks when a correction occurs. My advice would be to not look at your portfolio during these events. That is, unless you plan to buy more. 25. Anyone can invest. You do not need to be a genius to succeed in the stock market. Just be curious, patient, and willing to learn. Hopefully, these 25 investing rules will be as helpful to you as they have been for me. Thanks for watching, and remember to like and subscribe.